Sorry about last week. Mix up with the timetable. And we have 1 hour to come to Hamilton. So I'm based in Tauranga. So I teach over there finance and accounting, and I travel to Hamilton on Tuesdays to teach this paper. So I'm teaching this paper for the last 1 year. So this is the 4th time. So as you know, the PV FinTech started last year. And this is obviously the first paper, FNTEC101. I'm teaching the FNTEC101 since the start of the degree. So I've given you some introduction in the last week lecture about the assessments and other things that you need to do. So one of the important tasks that you need to do is obviously choose your group. I'm not sure how many of you have enrolled or selected a group. Over here. Okay, so I only have one response till now. So make sure that you choose the group. So where can you find a tutorial presentation group? That's, just in this introduction section. Just after the tutorial link. So make sure you choose your tutorial presentation group. Now, why this group is important? Because from next week tutorial, so this week, the tutorials will start. So Thursday, you've got your tutorial from 3 to 4. So Isaac is going to take the tutorials. He has done it last year, like last semester as well. He has a PhD in mathematics, but he has a keen interest in FinTech. So he will be taking your tutorials. Now, in majority of the tutorials, you would be preparing for the tests, okay? So I'll give you test questions. Like this week's tutorial, he is going to cover some questions that discusses the contents that we have covered last week. Okay, so these are the questions for your tutorial, and he's going to basically discuss how you're going to write the answers to these concept questions and what you need to cover and so on. Okay, but in 4 tutorials, you need to do the presentations. I'll just go over this again, and then we can start with our class today. It's very slow. Yeah. So starting from week 3, then in week 5, week 10, and week 13, you've got your tutorial presentation. These presentations must be done in group. Obviously, in a tutorial, you only have 50 minutes, so it cannot be done individually. So we can only accommodate maximum 5 groups, 10 minutes each. So you will have 10 minutes to present your presentation. And so therefore, only 5 groups max. And yeah, in that week 3, you'll have to do your presentation. Now, what we are presenting on, again, I've already given this. So if you go to week 2, Moodle page, tutorial presentation 1, this document gives you exactly what you're presenting. So the question is, consider one shortcoming of the current financial system in New Zealand context. So we're going to go through some of those financial shortcomings in the financial market broadly, globally. But then in the presentation, you need to look into the New Zealand context. Okay, so which aspect of the financial system is most inefficient in your context? Okay, And then how does the shortcoming of the financial system influence your personal or business finance? Okay. So I know like some of you may have some business or you've got a family business where you have seen some inefficiencies that is affecting your business outcome and performance or in your personal. And again, that's the reason why I've done this group presentation, because individually you may not have those experiences, but as a group member, like one group member may have experienced that, and then you can build on that, okay? Or you can discuss together to see if there is something that you can come up. If you are struggling in this context, you can obviously come to me or the tutor, and we can help you with some of the context, some of the broader context, okay? And also after today's class, you will get that understanding, what are the financial inefficiencies. I've also given you the marking scheme, okay? So how we are going to mark the organization, content, delivery, visual aids, and so on. Now, the first presentation, I'm not sure like if you have presented before or not. Maybe this will be the first time you're presenting. So we understand. So we're going to give you more guidance. So come up with examples, visuals, and try to prepare your presentations more interactive. Okay, so try to interact with the audience, because obviously you will have your other like participants or like other students attending the tutorial. So try to interact with them. Okay, so keep some questions and so on. So think about how you're going to interact. The tutor will give you detailed feedback after you have presented. So I'm going to share that feedback with you, which will help you to develop in the next presentations. Okay, so that's your question. Now, again, you've got a Moodle discussion, which is due this week. So it's due on the 20th of July. What are you discussing? Again, the same discussion. Okay, so from this Moodle discussion, you can develop some ideas. Okay, so how you're going to respond to this discussion, I can see already there is one response. So if you click on that discussion topic, it will take you to the discussion forum where you can click on the reply, and then you can post your response to this particular question. So there are two questions or prompts. What shortcoming of financial system have you identified in your context? Again, you can see it is pretty much what we have, like what you're doing in the presentation, right? So here you're learning from your classmates, okay? So if you read the discussions, if you read the other post, you basically get some idea for your presentation as well, right? So what are the shortcomings of the financial system you have identified? In what way the financial system outdated or unfit for purpose? Now, you don't need to answer to both the question. You can choose one of the question, and then, so these are just prompts, right? It's not like you have to answer to both these questions, okay? And then you can form your discussion, post discussion by, so I've given you that you need to post the first discussion by Wednesday, 16th of July. And then once you have posted, you should be able to see other people's posts. Okay, so this forum is set up in a way that you won't be able to see other people's posts unless you have posted something. Okay, so which means you'll have to post something before you can see other people's posts. And then once you get access to the other people's posts, then you need to reply to two other posts. Okay, the two other posts. So how you do that? So once you have posted, you will see that you will get access to all these other posts, and then you can just click reply on their post. And then you can say, okay, so what do you like about them, or if you agree with them, or what you disagree with them, and so on. Okay, or you can just, like ask a question, simple question. Okay, so how do you like get over it, and so on. Okay, so it's basically like why I'm doing this. This is giving you an opportunity to interact. Okay, you might not interact in the class that much, but virtually you interact a lot more. So this is an option, an opportunity for you to interact with your other classmates. Okay, so clear with this? These are the two upcoming assessments. First, the Moodle discussion, which is due on the Sunday. Okay, but before that, by Wednesday, make sure you post your first comments over here, like make your first post, and then by Sunday, you need to reply to 2 other people's posts. Okay, make sense? And then next week, tutorial, you will have to do the presentation. So by this week, you have to make sure that you form your group. Make sure you attend the tutorial. Okay, it can be online or you can attend in person. So the presentations can be made online or in person. If you are making online presentation, make sure that your other group members are also presenting online. Okay, otherwise it's really difficult. We have tried this earlier, but it doesn't really work that a few people are online and like few people offline. It becomes messy. Okay, so we will not do that. So all the people who wants to present online, then that group must be online. Okay, if you're presenting offline, then present offline. Okay, but it has to be done in that tutorial time. All right. So we are clear with the assessments. Any question? If you have any question while doing it, just send me an email. Okay. So be in touch. Okay, so in the last class, we have looked at the structure of financial market. And what is the structure? So which institution sits at the top of the financial market? Can somebody say? Which institution is at the top of the financial market?
Reserve.
The central bank, Reserve Bank, yes. The central bank. So central bank is at the top of the financial market. Then we have got the commercial banks. Then we have got the capital markets, which includes the stock market or the bond market. Okay, and then you have got all the other ancillary institutions like the derivatives market, and then you have got the investment bankers, and then after that you have got the shadow financing. So the shadow financing bit we are going to cover all through this course. So who are the shadow financiers? Venture capital, okay, angel investors, government seed financing. Okay, so government also have their own venture capital, right? So New Zealand Growth and Infrastructure Fund, NZGIF. And then we have got, and then the crowd financing. Okay, so the equity crowd financing and so on. So we will talk about crowd financing. So these are the financing institutes that we have from where we can raise capital for our business or personal needs. But then we also have got the payments, right? So that's another important part of the financial market with processing the payment, the credit card companies or the like the Visa, the MasterCards, and now we have got all these mobile wallets, right? So Apple Pay, Samsung Pay, Google Pay, all these different payment clearing systems that are coming. Okay, so that's the broad structure of the financial market. Now, well, we have got all these different institutes. We should expect it to work well. Okay, when I say work well, it should be efficient in a way that we're, like it is on time, and it should be not so expensive. But the issue is when you go and try to make a payment using your PayWave, how much do you pay? What is the charge? Have you noticed? Anybody try to pay using PayWave? Have you looked at the charges that they're charging?
Yeah, isn't it like 50 cents?
It's a percentage of your, so it's like, it can vary between, like, can go all the way up to like 2 point something percentage. Okay, so it's expensive if you think about those transactions, right? So why are we making those payments? What's the point? Okay, so let's explore that today. So we will look at the flaws of the traditional financial system, and then we will try to see if FinTech can address. Although we are not going to address the question that if FinTech can really solve this issue, because we are going to like ask this question all through the course. Can fintech solution address the financial flaws, like financial system flaws? So remember the three pillars. We have got the lending, right? What else do we have? The lending in the financial market, then we have got the trading, and then we have got the payments. Okay, so lending, trading, and payments are the three pillars of the financial market. And that's we're going to, like that structure we are going to use all through our course. So we will see what are the issues in the lending system and what are the technology that is currently used in the lending system. And then we will look at like what are the issues in the payment system and what technologies we have, and then similarly in the trading. Okay. Now, if we think about lending, what is the most important, function in the lending system? You need to understand who should get the lending. If you think of a bank who is providing home loan, the first decision that they need to make is who is eligible. Why? Because it's a risk. If you think about banks or any other financial systems balance sheet, what is their asset? Have you thought about it? What is the asset of a bank? Of a bank? Has anybody done some accounting? Like for the university, what is our asset? Computers, furniture, the building. That's our asset, right? That's the university. But if we think of the bank, what is their asset? Yes, they've got computers. Yes, they've got buildings, equipments, and so on. But the main asset is the loans. That is their asset. Okay? And that's a risky asset. And that's how the financial institutes are quite different from a traditional business organization. So the financial institutes' asset are the loans. And if they mess up with the loans, the whole asset side will be at risk. Okay? So then, how do they decide who is going to get the loan? Credit scores. So we all have a credit score. Okay? So the bank will look at our credit score and then they will decide if we are eligible to get a loan. Any kind of loan. Can be home loan, personal loan, any financial institute who is involved in lending money. That can be chain financing or any other personal financing as well. So then how the credit score happens? So the credit scores are crucial for banks and other entities to assess the risk and maintain profitability. Okay, so why credit score is important? It's for that risk. But the issue is most of the, if you think about the current credit scoring system, many of us become subprime. Okay, so many of us become subprime. Why? What does subprime mean? That is, we are not, eligible, or we are we don't attain, or we don't meet the required credit score. Okay, that's how the current system is built up. So subprime borrowers often face difficulty in securing credits and are usually charged higher rates compared to the prime counterparts. Later today, we will look at what's happening with the Maori businesses. If you think about a Maori business trying to raise a business loan, so they go to a bank and try to get some capital, some loans, some debt. Now, when you go for a business loan, you need to keep some collateral, right? The collateral that the Maori businesses are keeping are the lands, but the issue with those land is it is a communal ownership. Now, with the current system, banking system of New Zealand or any other part of the world, because New Zealand banking system also meets the standard, they need to meet the standard of the global banking system. Now, when they look at these communally owned assets, those are considered as risky. Okay, and so as per RBNZ research, the interest rate or the the cost of loan for the Maori businesses are much higher as compared to a non-Maori business. And that is only due to that current credit scoring system. Okay? Because we are just picking it up from the Australian system. That's what we are doing. So we are charging more interest beyond loan access, credit score influence employment opportunities, rental agreement, insurance pricing, making from a pivotal factor of the asset. So what is the error? So there can be errors in credit scoring system as well. So if there is like very simple error, like your name can be wrong, your age can be wrong, that can lead to a wrong credit score. Outdated and incomplete data in the credit scoring system. And another important aspect is, if you're a new immigrant to, let's say, New Zealand, you will basically have a zero credit score because you will not have a history of transaction. Because when you travel from country, like when you migrate from a different country, you don't bring your credit score from that country. So you're starting fresh over here. So a new migrant in New Zealand will essentially have a zero credit score because they have got no transaction history. And that makes them more risky. Okay? And it can be true for like other people as well. Right, so I've talked a lot. Let's just watch this video now. And so this video that we're going to watch now, they will talk about the US credit scoring system, how it works, and what are the problems with that US credit scoring. Let's look at it, see if it works. So much easier.
In older cities, you should look up, but in Budapest, maybe even more so.
As a first-time visitor, you should use your language.
Historical layer, some sort of folklore or legend to find.
And that's the success recipe for Budapest, because if you look up, you can see the original beauty.
America runs on credit. The 3-digit score represents how likely a person is to pay his or her bills, and it impacts almost every aspect of an American's financial life.
It's like your passport into everything that you need to do as an adult.
And it affects so many things, not just access to credit. So your ability to get a credit card, a mortgage, a reasonable car loan. Landlords use credit reports and credit scores. So it'll affect your ability to get an apartment. Insurance companies use them.
Having a low or no credit score can have severe financial consequences. 42% of Americans said that their credit scores prevented them from accessing financial products, like credit cards or loans.
Life can become more expensive and more difficult as your credit score falls.
But some credit experts argue that the current credit reporting and scoring systems have major issues.
The current credit scoring system, as it stands, is flawed.
And this error of being fundamentally misaligned has huge ramifications across the system for millions of Americans.
Others say many of these criticisms are misguided.
The reality is that the credit reporting system that we have here in the United States is sort of like the crown jewel of the world.
A lot of the criticisms are based on some fundamental misunderstanding of how credit scores are calculated and how they're used.
If you take a moment to not be knee-jerk angry about financial service for a minute, then I think a reasonable person would have to conclude that these are actually good for consumers relative to a world without credit scores and what that would mean to our bottom lines.
So how do credit scores work in America? And do they help or hurt consumers? A credit score usually refers to a number between 300 and 850, which represents the holder's financial stability and credit worthiness. The higher the number, the better a consumer looks to potential lenders.
Credit scores in the 500s are considered to be very bad. Credit scores in the 600s, we're starting to use terms like subprime, near prime, getting close to average, but you really need to get yourself into the 700s before you actually hit the national average, which is between 710 and 720, and then start working your way into the elite level scores, which are well into the 700s and certainly into the 800s.
Credit scores and reports are two separate things. Reports refer to statements containing information about your credit situation, while scores are calculated based on that information from the report.
The credit report is like the test you took. The credit score is the grade you got on the test. One is influential over the other, but they're not the same thing.
Today, scores calculated by Fair Isaac Corporation, or FICO, have become the industry standard, used by 90% of top lenders. They're calculated using 5 main categories: 35% from payment history, 30% from the amount owed, 15% from the length of credit history, and 10% for new credit and the types of credit you have.
It's based on an analytic algorithm. So we look at actual data patterns to say what helps us predict whether you're going to pay credit in the future.
One of the main benefits of having a credit score is that it provides a quick and empirically sound method of measuring credit worthiness. Americans are borrowing today more than ever, with household debt topping $16 trillion during the second quarter of 2022, making credit scores crucial to many businesses.
It allows lenders to make very, very precise decisions and have a very deep understanding of the likelihood of someone paying you back.
Experts say that such a streamlined process is also the reason why Americans have been able to enjoy low interest rates for so many years.
The credit scoring system allows industry to quickly and cheaply make decisions about whether or not you're going to have credit. The cheaper it is for the lender to decide whether or not they're going to give you credit, in the aggregate, the lower the cost is for the lender, and hopefully that gets passed along to the consumers in a more efficient system.
Without this system, lenders are going to do what lenders do, which is they're going to mitigate their risk. What that means in practical terms is higher interest rates, because that's how lenders mitigate risk. They charge everybody more to subsidize the risk that's posed by everyone, or more declinations. It's easier to say no to an applicant than to book an applicant who you know is going to default on a loan.
Representing a person's credit worthiness using numbers also allegedly helped prevent lending discrimination. Lenders often relied on more subjective methods of evaluation prior to the invention of credit scores.
Credit scoring, when it was first developed, was an advancement. It is better than having some banker sit across from you and judge you and read the information in your credit score, because they bring a lot of their subjective analysis and their own life experience into the analysis. And if their life is different than your life, frankly, if it's some white guy sitting across from some woman of color, that analysis can be flawed.
If the information is not on a credit report, it is systemically impossible for your credit score to be influenced by it. What is not on your credit report? Things like your gender, your sexual orientation, your politics, your level of education, how much money you make, the socioeconomic makeup of your neighborhood, your level of education.
So we're able to assess credit risk looking only at the past behavior that is on the credit report, and only to the extent that it predicts future credit risk.
Yet despite its good intentions, experts say that the credit scoring system still suffers from discrimination. A survey of 5,000 US adults found that more than half of Black Americans reported having a low or no credit score, compared to 41% for Hispanics, 37% for whites, and 18% for Asian Americans.
Credit scores are based on past performance, so you're going backwards in history to make a judgment about the future. The further we go backwards in history, the deeper the structural racism in the United States was.
Intentional racism that happened decades ago gets baked into the cake, into the system, into the institutions and policies. of our society. And that kind of structural racism requires no animus, no intent, but it still hurts Black and brown consumers.
If your parent put your name on a bill because they had bad credit and then they were delinquent, you can turn 18 and inherit derogatory information on your credit report through nothing that you did. If you're a new immigrant in this country, your prior credit history doesn't travel with you. These credit bureaus are mostly domestic, so you show up with nothing. And by the way, a blank slate is a bad place to be in credit scoring. It means that you're unscored and your information starts off low and poor.
19% of American adults have no credit history or are considered unscorable by existing systems.
Sadly, what scores do is they sort of amplify those inequalities because they go in and they say, okay, you're already disadvantaged. Now you can be doubly disadvantaged because the score then sort of objectifies that you are somehow not worthy of being given a chance, that you are somehow deserving of much higher fines and fees than everyone else.
Errors in credit reports can also often lead to miscalculated scores. A survey in 2021 found that more than a third of those polled found errors in their credit reports. Of more than 700,000 credit or consumer reporting complaints received in 2021, more than half pertain to incorrect information on their report.
For me, it was a different person named Aaron Klein who didn't pay their cell phone bill in New Jersey. I also happen to live in New Jersey for graduate school, and this stuck with me for years.
1 in 20 have an error so serious it could cost them either the ability to get credit or a job or an apartment.
However, those within the industry argue otherwise.
When we look at our data, it is astronomically reliable. So we're constantly auditing and evaluating our data. Our regulators are examining us on a regular, ongoing basis. So they're looking at all of our systems around data integrity, data reliability, how we engage with consumers, et cetera.
Under the Fair Credit Reporting Act, credit bureaus are responsible for correcting any inaccurate information on their reports. But research has suggested that many consumers find errors difficult to get fixed.
Credit bureaus are like a judge that always rules for the defendant. So if your mortgage servicer says you're late, even though you really were never late, and you have documentation that you were never late, it will still show up as late.
Fixing mistakes is expensive and time-consuming for the credit reporting and credit scoring industry. They are not incentivized to have accuracy, particularly if the mistakes are symmetric and even out.
Our entire role in the consumer credit ecosystem is to provide reliable, accurate information. If we were unable to do that, nobody would have any interest in engaging with us whatsoever. Our position is that the system only works and we can only succeed if our data is incredibly reliable and accurate, and that means engaging with consumers continually to try to make sure that they're able to effectively managing their credit and that they're able to effectively feel as though they can interface with us about any concerns that they have.
Another main concern is the lack of regulation and oversight that can ensure fairness and transparency within the industry.
You know, I think the idea that the industry is unregulated is a fiction. And, you know, we operate in one of the most highly regulated spaces possible.
You have a 50-year-old federal statute called the Fair Credit Reporting Act, which essentially mandates everything having to do with credit reports, from our rights to challenge information, our rights to freeze our credit reports, our rights to get copies of our credit reports. You have the Consumer Financial Protection Bureau, which regulates credit bureaus vis-a-vis credit report accuracy. You have the Federal Trade Commission that shares that regulatory responsibility.
I must say that the Consumer Financial Protection Bureau, which took over oversight of this industry about 10 years ago, they've done a really good job of trying to reform the credit bureaus. But I would go further than more regulation or even more laws.
Over the years, credit reporting and scoring agencies have made several changes in response to the criticisms against the industry. Perhaps the biggest change comes from the use of alternative data to improve accuracy and inclusion.
They've started trying to incorporate other quote unquote non-traditional information. For example, if you pay your mortgage on time every month, your credit score is going to increase. But if you pay your rent on time every month, nothing happens because that information isn't reported.
We've innovated with scores like the FICO Score XD and the Ultra FICO score, they augment traditional credit data with rich alternative data, such as how you pay your telco utilities, as well as information that's in your checking and savings account. The point of these new scores is to allow consumers to find other ways beside the historical credit to demonstrate their ability to repay credit.
More regulatory changes could also be coming. Two bills, the Protecting Your Credit Score Act and the Comprehensive Credit Act, were both passed by the House in 2020, aimed at overhauling the credit scoring system with more oversight and provisions aimed at protecting consumer credit. They have yet to be put on a vote by the Senate.
One of the initiatives that we're championing, because we really think the solution to a lot of these concerns around how do you help consumers access financial products is an alternative data piece of legislation called the Credit Access and Inclusion Act, which would really encourage the reporting of rental data, utility data, bring new data into the system that would allow literally millions of Americans to access financial products and services.
But ultimately, credit in its current state is dependent on the consumer's financial decisions.
I'll tell you the two things that you need to do, and it will be impossible for you not to have a good score. Number one, never, ever miss a payment on anything, ever. That's easy. It's writing a check at the end of the month and paying your minimum payment, right? Number two, you got to stay out of credit card debt. And I'm not saying don't use credit cards. I'm saying don't max out your credit cards. Don't use them as a supplement to your income or to keep up with the Joneses or to impress somebody. Pay your bills on time, stay out of excessive credit card debt, lather, rinse, repeat, and you're going to have fantastic credit scores.
You know, how you manage your credit is a sign of responsibility. It's not. A lot of people have negative items on their credit report because they were the victim of bad luck, not because they're bad people. So they got sick, they lost their job, and now they can't pay their bills, and their credit report's going to stop them from getting a new one. That's crazy.
Okay, so that was a long video, but then it kind of summarizes how the credit score works and what kind of information is included in the credit score, and then what are the issues at the moment we have. Okay, so clearly we need alternative data, right? So some qualitative data that needs to be included, including, so like the first things first, like the credit score doesn't include the education level, okay? But there's a fairly good understanding and a body of research that talks about that with higher education, you have got more financial literacy, which could lead to better, management of finances. But then also we don't have the qualitative data, like in the last, the lady talked about sickness and you lose your job, the macroeconomic situation, which is out of our, our control, like COVID. During that COVID time, a lot of jobs were lost. That had nothing to do with performance or anything else. It was just the situation at that point. And if the credit scores are affected due to that, at the moment, the credit scoring system is set up in a way that it will not be able to consider those external shocks that we get in our economy. So obviously there is issues with the credit scoring system. So the task that I have before I move on to the payment system now is look at, okay, so the credit scoring model typically rely on the quantitative data. That's what we saw in the video, such as income level or credit history. However, qualitative data can also play a crucial role in assessing the borrower's creditworthiness. Now, I wanted to walk in group and consider what are the qualitative data. So what qualitative factor, so these are the prompts that you might use. What qualitative factor might lender consider when evaluating creditworthiness? How can these factors complement the traditional quantitative data in credit scoring? What are the potential challenges of incorporating qualitative data? And then let's start sharing. So I'll give you, let's say 10 minutes to do some Google search, talk to your, whoever is sitting beside you, and see what qualitative data we can include. So there's a lot of research already going on. on what kind of qualitative data we can. Okay, so I'll give you 10 minutes. Do some work. Come on. Active. Because this will give you idea for your presentation as well. You can work in group, or if you want to work individually, that's all right. Make sure you use this time to form your groups. Okay. You can even interact online, all those who are online, and see if you can form a group online, and also you can post your comments. Everybody is majoring, like you're in the BB FinTech thinking? Everybody? We are not in the BB FinTech, right? Yeah, yeah. So everybody is in the BB FinTech? Yes. What about your other papers, the mining papers?
It's my elective.
Yeah.
Your electives, so what are you majoring in? Good, good. Good for you. So later in the course, I will bring some guest lecturers from Westpac. So the chief engineer from Westpac will come and talk about job opportunities as well. FinTech space. So I'm not sure when, like which lecture is coming, but there's already, I mean, like Westpac and ANZ, they're both keen to work with us. ANZ has already committed that they will take around 4 or 5 interns, the third year obviously, and we'll like work with Westpac as well. So there's a lot of opportunity in this area to talk about that. Yeah. Yeah, right. Change. Oh, yeah. Immediate password back. Well.
Like how long? You can like job for a while. Yes. Challenges are like incorporating it. Case to case, no. In special cases. Yes. So I know when you it's gonna go. It's how do you predict it? Yeah. Yeah. Like what if you how do you just yes. Give them understanding numbers. Unpredictable scenarios. How do you conquer that? That becomes interesting.
Okay, so let's give it a couple of more minutes and then we can talk a little bit about qualitative data. Ready? Okay, who wants to start? Okay.
So understanding like job occupation and industries, because some industries are more stable than others. Look at that when evaluating creditworthiness.
Yes, industry, definitely, yeah.
Criminal history.
Criminal history, yeah, yeah. I mean, that's a big one as well. Anything else? Qualitative data?
Whether they're like a resident or on a visa, because we're talking about immigrants, how they usually have no credit scores.
True. Yeah. Any other information?
I guess like with payments and stuff, like if they pay like in full or like in sections, it kind of like gives you like an idea of the characteristics and stuff.
Exactly, yeah. So how often you are making the payments, or maybe it's a lump sum payments. If you think about IRD payments, like if you've got a date with like IRD, like if you pay off a lump sum payment with IRD, it's regarded as more responsible. Okay. Anything else? Any other qualitative data? Behavioral data?
Spending patterns,
Spending patterns, like what? Can you elaborate a little bit?
like how their budget and their financial situations.
Yes, okay, budgeting and financial situations, okay. Mhm. I mean, that spending pattern bit has to do a little bit more financial literacy. And now, obviously, if you read the literature on financial literacy, it says that obviously with more education, financial literacy increases. But my argument, I mean, that's what like I'm researching on now, is digital financial literacy. If you think about, like the financial services that are available out there, but if you're not aware of it, okay, so let's say the payment options, right? If you are going to consider a payment option when you're buying online, you can go for those buy now, pay later kind of options, or you can take other payment options like FPOS, and then there are other payment options like credit card and so on. Now, every payment option will have a charge or like there's a charge associated with all the payment option. And if you are not aware of those charges, you would end up using maybe the most convenient one, but that most convenient one will be the most expensive one. Okay, so it has to do with the digital financial literacy. Are you aware of what are the costs of these different services that is available out there? Okay, now out of convenience, there is a lot of us who are using PayWave, right? Or we are using Apple Pay without even considering what are the charges of those services. And that is adding up. Okay, because if you go to Pack and Save or any other grocery stores and you use your PayWave, they're not charging. But if you go to the grocery store, like the dairy store, they will charge. If the consumer are not aware of these differences, it can be very small, but it adds up. Okay, now these kind of information are not like behavioral pattern. Okay, so am I really aware of my finances? Am I really responsible of my finances? These kind of patterns are not included at the moment in the credit scoring, and that leads to a better credit scoring. But then the issue, like, what are the issues of including this data? Like you said, the criminal history. What is the issue? Can you think of an issue of including the criminal history into the credit scoring system? Yeah.
They did something stupid while they're young and now they're 40 and are like more responsible and have a family and stuff, and they're just trying to get a house but they can't because they, like, I don't know, stole a pen from the store when they're 17.
Yes, that's right. So it's obviously taking out their biases. I mean, the way you put it is actually good, because what I was thinking of is, sometimes some data can lead to more biases. If you think about criminal history in New Zealand, there is a bias, right? So if you think about the criminal history, including criminal history into the credit score, it can be biased. But then again, if we can take out those biases, then it becomes more usable. Okay, so at the moment, certain data is excluded from the credit score in order to avoid those biases. But in the pursuit of avoiding biases, we are missing out important data. Okay, so that's where obviously, I mean, later when we will talk about machine learning and AI in fintech, we will see that how machine learning is used to improve credit scoring, and there are companies who are actually doing it at the moment. But again, the issue with machine learning is that black box thing, sometimes it's very difficult to explain how a model has worked out a particular credit score. And then, I mean, it is foolproof, but from a regulatory perspective, it is difficult to explain. Okay, so that's like, we don't have that regulatory system at the moment that allows the bank to use those kind of credit score where machine learning is used more broadly. But yes, it's happening. At some point, I will bring in Shane Marsh from Dosh. Have you heard of Dosh? Anyone? Dosh. So Dosh is a neobank. It's a digital bank. Neobanks means the digital bank. So of New Zealand. So that's the first digital bank of New Zealand. They've got no physical facility. Okay. But now Dosh has tied up with Westpac. So Dosh is basically processing all the home loans for Westpac, and they're using a lot of machine learning and AI in like processing the home loans. Okay, so already that's happening at the moment, where Dosh has got a banking license and they have now tied up with Westpac in order to process those and make it more faster and cheaper. Okay, so that's to do with the credit scoring. Okay, so let's take a few minutes break. So let's take a 5 minutes break. And then we are going to start with payments. So again, you see, I'll use another video to show you how the payments are processed, because if I talk about it, it won't be that much clear. It's important to visualize this. And so this videos helps you to visualize how it works. Okay. So let's take a 5 minutes break. So we will start again at 1:10. Okay. What is yours? So shall I continue and finish it early, maybe? Okay. All right. So let's watch this video and see how the payments are processed. So this will tell you exactly at the moment how what is the technology behind processing the payments. If it works.
Payments are in the financial news constantly, and global cashless payment volumes are set to increase by more than 80% from 2020 to 2025, up to almost 1.9 trillion transactions. But how do payments work? What goes on behind the scenes every time we tap our cards?
So payment rails are really at the very heart of it, just the ability to guarantee transfer of funds from one place to another. And I think it's very easy to overcomplicate them at one level.
All payment rails operate because of an instruction. So somebody's asked for something to happen. So what, ordinarily, if I was making a payment to you guys today, I'd basically sort of go onto my online banking and say, look, I want to make a payment, £250 to David Breer, because he's promised for years and years and years to buy me a beer, never has done. All right. And so effectively, I put that instruction in. That instruction is converted into a message that's run over the payment rails to David's bank. My bank's confirmed that they've taken £250 out of my account. So it's good for David to have my £250. He gets that into his bank account. He sees it on his statement or in his smartphone. And he then knows that he's been motivated enough to run down to the pub, order 2 pints of Adnams, and I'll see him at 5 o'clock tonight.
Payments rails are facilitators of any payment you might want to make. On the surface, it seems simple. But to enable the transfer of money, there is a complex system of back-end checks and transfers that run along the payments rails until the transaction has been cleared and settled. Essentially, when the person A has made the transfer to person B, or, in the case of a purchase transaction, the buyer has the goods and the seller has the money. The time taken to clear and settle varies depending on the rail and payment method you use, as we'll see in due course. The best version of this is real-time payments and settlements. But in the current system, that is not always possible.
And real-time money isn't a new concept. When groats were invented and when people walked around looking for gold in the streets of London, we used to swap coins around. That's real-time money because you give somebody a coin, it's settlement finality. They then own that coin. It's the same as if I was to give you a £10 note today, you then have that £10 note. And it's interesting that the friction associated with moving physical currencies is less than the friction associated in many instances of moving digital currencies today.
As Nick said, real-time transaction in the physical world happen all the time when people exchange cash. This was also the case in the past when people exchanged goats for fish, or even goats for gold coins. It was a real-time transaction. The payment was settled and the debt cleared instantly. Over time, people began trading goldsmiths' receipts in lieu of physical gold. As trade expanded, these came from a variety of different goldsmiths, often from much further afield than their local town. The goldsmiths needed to set up a network of trust in order to clear and settle the transactions.
So what they knew was that if you had a receipt that was drawn on goldsmith A and the goldsmith in a different country trusted that goldsmith, they would actually be happy to take that receipt as proof of payment. And that morphed eventually into the concept of things like bills of exchange, bills of lading. We would often know those in our daily lives as checks.
Hundreds of banks produced checkbooks on the basis that it was far easier to write one note as a promissory note than taking thousands of coins across towns and cities, particularly bearing in mind that you were looking at a period of huge industrial explosion of projects that required a lot of payments taking place to a lot of suppliers, far more than ever before. So you ended up with this supply chain, which we wouldn't have talked about in days before the Industrial Revolution, because the supply chain before would have been just the guy buying your sheep some wool and you buying food for the sheep, whereas now you're talking about building railroads and building factories. It's a very different environment. And so the check became something that enabled more and more trade with trust as a promissory note for businesses.
Promissory notes and checks made everyone's lives a lot easier and safer when they didn't need to carry physical gold. However, these checks still needed clearing and settling to ensure sellers got their money and the buyers' accounts were debited.
It used to be very complicated to process the payments and also quite costly. So check processing was originally based on a physical exchange of checks. So the banks would actually get together and exchange bags of checks, typically from the collecting bank to the issuing bank, for reconciliation.
In 1770s England, the Five Bells Tavern was one such location where bank clerks used to meet to exchange their checks. They would balance out the checks and settle the differences in cash. If Bank A owed Bank B £250 in checks, but Bank B owed Bank A £200 in checks, they would net the difference and only £50 in cash would be exchanged from A to B. This process of physical transfer took time and was also risky if the other bank was not solvent enough to pay the debt. It can still take up to 3 days to clear a check, even over modern payment rails. Is the time of the check over?
I think the use of checks is diminishing rapidly. And I think the pandemic is probably going to speed that up. If you send a check to somebody's office and they're not in the office for 18 months, the check's expired. And so I think that there's a move towards, digital payments. I mean, most businesses now will pay electronically online. So I think checks have pretty much, had their day.
Today, the majority of the money moved around the world is transferred digitally. But how does this process happen?
If you want to transfer funds between two people, you've got several actors in this party. You've got the primary actors, i.e. the people who are doing the trade, call them A and B. Those people will probably have bank accounts. And those bank accounts will need to share some mechanism by which they can transfer the funds. So they'll probably have a bank account with someone else who almost invariably will be the central bank. So when you initiate a trade, what a payment rail will do is effectively, A will use whatever mechanism, a card, a check, a faster payment, and they will effectively go to their bank, and the bank will send a message to the other bank to say, right, this person wants to initiate a trade to this account. Once that has gone through, you then have the process of clearing, and that really means about clearing the debts, okay? What has to happen in order for clearing to occur is that settlement needs to take place. Settlement is really where the money moves from Bank A's account into Bank B's account, and they do that through their shared bank account, which almost invariably is the Bank of England, or the central bank in whatever country you're in. In the Bank of England, they have, RTGS, the real-time gross settlement system. So every bank will have an RTGS account inside the Bank of England. And in order for that debt to be cleared, fully settled and cleared, it needs to have been moved on the Bank of England's books from Bank A's account into Bank B's account. And as soon as that has occurred, then that debt has been cleared.
The central bank is one of the most important players in the cycle. Alongside ensuring the banks and rails are regulated and efficient, they also hold ledgers for every bank in their country of origin. In other words, they are...
Well, they're effectively the bank's bank, which basically means banks use it to store liquidity that they hold, and banks use it to transfer liquidity that they hold to other banks. So I think it's important to know that the only place where money actually exists is at the central bank level. So wherever there's a payment from one bank to another, there's typically a transaction that happens at the central bank.
The only place money really moves is in the central bank. The process of clearing it through the central bank varies depending on which payment method and rail you use.
You typically have three types of payment infrastructures. You have a high-value payment infrastructure, what they call a real-time gross settlement infrastructure for high-value payments that goes straight into the central bank. And the minute you've paid, it's done. The second method that's always been there is ACH payments, and that's typically split into two parts. On the one hand, you have direct debits. On the other hand, you have ACH credit payments, which is typically not real time. In the UK, it takes 2 days for the money to arrive in your account. This is typically used for non-urgent payments. Most people would receive their salaries through that still. The third one is what we call real-time payment system. Those systems typically operate on a net settlement cycle. So the central bank settlement is not happening with every single payment, it's happening in bulk.
And the banks have agreed, as part of the fast payments rail, to, if they receive a message from another bank, to credit the other person's account in real time. So as far as the person is concerned, that debt is settled and has been cleared, so it's money they can use. Actually, that hasn't been settled from a financial perspective, because what happens is that all of the banks total up all of their monies over that 2-hour period, and they net out the difference. And they'll say, right, I owe Bank B this, I owe Bank C that, Bank D owes me this amount of money. And then they'll basically orchestrate that through the Bank of England, moving the appropriate amounts of money through their RTGS Bank of England accounts into the appropriate other banks. That cycle is then settled, and it has been fully cleared through the Bank of England.
That system works if everyone is moving the same currency and under the same regulatory process. Clearing between different currencies is harder, as there is no central global authority who oversees everything. When you come to do international payments, it means the central banks of two countries have to be involved in the process.
For every single foreign exchange transactions, there are basically two payments involved, one in one currency, the other one in the other currency, and a lot of reconciliation, which ultimately is what makes foreign currency more complicated than single currency transactions.
At the moment, I think still quicker to take money on a plane to Australia and deliver it by hand than it is to wire it. All right, and the reason why I know that is I've done that. I've been to a conference down in Australia and we wired $20 down, and I got there and I took 20 Australian dollars with me, and the presenter at the conference hadn't received the $20, and so I gave him the $20 on the stage.
Tesla's stock is crashing. The headlines say Elon's empire is collapsing. But what if they're all...
While Nick's physical $20 made its way directly to the payee, the digital $20 transaction process has no tracking. The conference presenter had no idea when it would turn up. This is a common problem in many payments processes.
The most frequently asked question in banking is, where is the money? All right, that's nuts. We should know where our customers' money is, and we should want to move that as quickly as efficiently for them from point A to point B to satisfy their instruction on their money to their customer or client or wherever it's going to. And today that's, it's slow. The UK, for example, we don't have a fully transparent, fully operational 24/7 by 365 payment system. It doesn't exist. Yet in India, they do. India's RTGS platform went live just over a year ago, and it's 24/7 by 365. And they made a specific decision that in order to reduce financial friction in their country, to move money around quickly, the only way to do it was have real-time money. And so I think that in the UK market, we need to catch up. And I think that the technology capability to deliver that now exists. And that's what RTGS Global does. What it's doing is saying, look, we want to move $1 trillion from the Federal Reserve Bank in New York down to Reserve Bank of Australia. Can we do that, please? Yes, we can. How long will that take? 300 milliseconds. Can we do that on a Sunday? Yes, you can.
While the technology may exist, the infrastructure and processes are not yet in place across the board. What can we expect to see more of in the future of payments?
There are a lot more micropayments. There are a lot more things that you pay for on the go. And I think that will only go up. So I know some of the car companies are working very actively and effectively turning the car into a payments device. That as a driver, you don't need to worry about paying for fuel, paying for road tolls or whatever anymore. Payments are the unpleasant part of the buying experience. So it needs to be as simple, as straightforward, and as invisible as it can be.
I think that by the end of 2022, somewhere between 25 to 50 of the major currency corridors will be operating atomic tech settlement systems to facilitate customer service. They're not doing it for any other reason, because if you don't facilitate customer service improvements, there's no value in the change. There is zero reason why it should be slow.
So again, that's a overall idea of how payment system works. And so it's complicated because there is a lot of clearing that needs to happen. Now, if you think about the need of commercial banks and the central bank, that gives you an idea why it is so important. Because somebody has to make sure that all the bank accounts from where the money are getting transferred to, it has got the money that they're claiming to. Okay, so that's the clearing process. Okay, if that central agency was not there, then obviously the payment systems will not work. Now, yes, and I've got a chat over here saying that the blockchain payments are faster than traditional centralized payment. Yes, I mean, blockchain payments, obviously you're thinking of Bitcoins or other cryptocurrencies. Payments are faster because the whole clearing process in that cryptocurrency scene is quite different as compared to a traditional financial system. So when we will talk about Bitcoins and cryptocurrencies later in the course, we will look at how the clearing is happening. But in the traditional financial system, the clearing is quite complex. And it is complex because it's in different countries, the payments are happening in different countries. We have got bank accounts with different banks, and that's creating that complexity. Now, in New Zealand, already payments are becoming more efficient. So later in the course, we will talk about open banking. So what's happening is if the data is available to these clearing agencies, where we exactly know how much fund is available in each of the bank accounts. Okay, so that data sharing is there. So there's a central agency where all the data sharing is happening real time. Okay? It has to be real time, the data sharing. That will bring down the cost of payment and the time it takes for the payments to clear. Okay, and ANZ, BNZ, Westpac, ASB. So they're all they have now all opened their payment data, obviously with customer consent, and so we will see that the payment systems, like the payments, will be processed much faster in New Zealand now. So that's one of the fintech innovation that's happening. So this is another issue, like another inefficiency that we can see in the payment system. If you think about like a slow transfer, like when you go to your Pack and Save or like Countdown and so on, and when you make a payment, you will see that a payment will be pending on your bank account, right? It's not immediately gone out, so it's pending in your bank account, which means that that store or that business haven't received their payment. Okay, so it's not like that cash is not available for them to use, and that has a cost. That has a business cost. So someone is losing interest. That business will have cash flow issues. So let's imagine if it's on a weekend, it will take a full weekend to clear. It takes quite some time for the payments to clear. So that is creating an issue with the small business. So the slow payments are particularly affects those with less financial cushion. Delay in salary deposit can lead to overdraft fees for individuals living paycheck to paycheck. Even if you think about your salaries, all those who are working, like you get your pay slip. So basically you get a pay slip when the payment has been processed, right? But then there's a lag between the time you get the pay slip and when you actually get the payment. Okay, so that's again that slow transfer. Now, beyond personal hardship, slow payment lock up significant fund that could otherwise be used productively. So also increasing risk and administrative burden for the business, particularly the small businesses. So they could, if the small businesses have got the cash immediately available to them, they don't need to take short-term loans, or they don't need to use the overdraft facilities. Okay, because when they're taking those short-term loans or overdraft facilities, that has a cost. So not only they're getting the payment, slow, but also there's a cost because of that slow payment, because they have to take short-term loans to process their payments. Okay, so let's say their supplier payments and so on. Okay. So if you end up in my Finance 305, which is the Financial Management 2 course, that's where we talk about, short-term financing, and there we'll see the cost associated with short-term financing, and that has to do with this slow transfer of payments. Now let's think about the credit cards. Now credit card is pretty much immediate. Why? Like when you're making a credit card payment, then the businesses gets the payment immediately. Why? Because the credit card takes the risk, right? So it's not a transfer from your bank account. Instead, the credit card is taking the risk, and then they're charging something. They're not doing this for free, right? Now, you don't see the charges when you're using credit cards, right? But then there is a merchant fee, and most of the time, the credit card will not allow the businesses to transfer these fees to the consumer. Why? Because if they transfer the fees to the consumer, then we will not be motivated to, we will not have the incentive to use credit cards, right? And that's their business model. So if we don't use credit card, then they will not have a business. So instead, they're charging it to the businesses. So there's a merchant fee. Now, obviously, these merchant fees, the businesses are not absorbing it. They have it built in the price. Now, think about it. I use credit card, and then there's another person who doesn't use credit card, right? So because I'm using credit card, the prices for the persons who are not using credit card are also increasing because the merchant fees are built into the price. Okay, so that's the hidden cost of transaction. Now, when I use credit card, I get certain advantages because the credit card companies incentivize credit card users to use credit card. We get reward points, we get all the other, discounts and all other facilities that we can get. Okay. Now, look at the inequality. So the credit card, who will get a credit card? Who have got a better credit score? Not everybody will get a credit card to start, right? Now, I'm using credit card, I'm also getting all the reward points and all the other discounts available with the credit card. The merchants are not charging me fees, right? The fees are built into the price. So all the people who are not using credit card are basically bearing the cost of this credit card use over here. And that's the inequity. Okay, so this is basically called the redistribution of wealth. Okay, so it's not from the rich to the poor. In fact, more credit card is being used in an economy. The redistribution of the wealth is going from the low credit score holder to the high credit score holder. That's how the wealth is redistributed. Okay, so there are hidden costs to transaction for credit card, economic disadvantage for lower income consumer. So lower income consumer who doesn't get credit card obviously won't be able to take advantage of the credit card, but still they will have to bear the high prices. Contractual limitations for merchants, so the businesses are also affected because of the use of credit card, redistribution of wealth, and then impacts on the overall digital economy. Okay, so all those who have the access can use it, but the ones who doesn't have the access because of low credit score won't be able to use it. So this is the inefficiency of the credit card payments. Okay, it works really well if you pay the price, but for the ones who cannot use it, they're facing the consequences. And that leads to this idea of financial exclusion. Okay, so the unbanked and underbanked. Okay, so even in New Zealand, we have got a lot of people who are unbanked. Okay, now unbanked can be the poor people or also the recent migrants. Okay, so they can also be unbanked. But then that's one story, who are unbanked. But think about the underbanked story. Okay, so you've got a bank account. What does that mean? What's the point of having a bank account if you cannot use the other financial services that the bank provides? So if you're not eligible to take a home loan, what's the point of having a bank account? All you're doing is getting your salary or wages in that bank account, and then you're spending the money out of it. That's all you're doing, right? If you cannot access the other services that the banks or other financial institutions are offering, what's the point of having a bank account? So that's that underbanked situation. Okay. So the impact of being unbanked, the difficulty of managing savings, securing loan during financial crisis. So this is that underbanked issue. Okay. So if you've got a financial crisis and you cannot access the loan because of the credit score, then obviously there's no point of having. Obtaining credit for business venture, acquiring insurance against unforeseen events, and so on. Okay, so if you think of this financial system that we have, so today we're talking about the inefficiencies. This is a big inefficiency, underbanked. Okay, you have a bank account, but you can't use the other services that the banks are providing. Okay, so then what are the barriers of financial inclusion? So financial exclusion is when you are not having access to the financial services. Financial inclusion is when you have access. So what are the barriers of what leads to financial exclusion? So high cost and low credit scores. So the connection between low credit score and reliance on alternative financial services. Okay. So let's say if you cannot access bank loans, okay, so let's think about home loan. Now, in order to access home loan, you need to have a minimum deposit, right? So that can be 10%, 5%, depending on the situation, or 20%, okay, depending on your credit score or situation. So then you don't have that 10% or 20%. So what do? You go to an alternative financing, like company, like Squirrel. Okay, so you can go to Squirrel and get access to those financial deposits. And there are other companies as well who can give you loan to meet those financial deposit requirements. But then the fees and the interest for those alternative financing are much higher. So can you see the spiral over here? So low credit score doesn't give you access to the loans or other services. To have access to those services, you go to alternative financing, and then you end up paying much higher fees and interest costs. Okay, so that's the spiral that we're in at the moment. Okay, so like if you go out there, there is a lot of investment, investment information out there saying you how to access home loans, but that is only pushing you more towards higher cost of interest. Okay. And then there's this issue of minimum balance requirement. It is not so much in New Zealand, but in other parts of the world, you have bank account, not just in US, in India and other developing, like emerging economy. You've got, banks that requires you to maintain a minimum balance. Okay. Now, why did it do that? Because the banks are like the whole system of the banks are set up in such a way that it is very expensive to run. Okay, think about those brick and mortar banks. You've got all these different branches and all the different other systems set up. They have to pay for those. Like it's expensive to run those banks, and so therefore, what they do is they will have a minimum balance requirement if you are having a bank account with them. Now think about those minimum balance requirement. When you put that money out there, sometimes it can be interest bearing, sometimes you may not earn any interest on. So basically that money is just fixed over there, earning nothing for you. Okay. So that's all around like this is the global scenario. Okay. So there are places where you have to maintain those minimum balances. So the economic and social consequences, so disproportionate impact on disadvantaged groups. So financial exclusion disproportionately affect the low-income families, obviously. By now you understand that. Racial minorities and those without high school diplomas. Wider economic implications. So the repercussions of financial exclusion extends beyond individual hardship to broader economic consequences. And here are some examples of those consequences that we can see in the US. So I built this teaching note based on the the US case study, because the US gives you a very ideal situation of a broken financial system, and yet it is just working somehow. Okay? It's a very, very expensive financial system. So the question is, this will be the last bit that we will cover today. What does FinTech means for financial inclusion? Okay. Before doing that, I'll just show you that there is more reading materials for you to understand the New Zealand context. So make sure that you read this, improving access to improving Maori access to capital. So read this bit, like this information. This is a really good material from the Reserve Bank that talks about like what I've give you, just a brief introduction. So this will talk about the financial inefficiency in New Zealand from the Maori business perspective. So you can use that as a case as well if you don't have any other example for your presentation. Okay, so you can just use that particular one as a case. Yeah, so that's the one, I think, yeah. So make sure you read that particular reading for your presentation point of view.
I chose Wix for my business because of its massive scope for functionality and freedom of.
There are multiple ways in which technology can help promote financial inclusion. The first way is to lessen information asymmetry. Usually borrowers or users of funds know more about their projects or other uses of the funds than anyone else. Indeed, they may try to hide some information from potential lenders or funders, or they may decide to invest in projects much riskier than they said they would. This information asymmetry, borrowers know more than lenders about their investment intentions, is one of the basic reasons for a financial intermediary. Adverse selection and moral hazard are both concepts driven by informational differences. By using algorithms and other pieces of electronic information found through fintech methods, a lot of basic information can be seen more easily by a potential lender, allowing them, whether a bank, a non-bank financial institution, a corporation, or just another person, to better see whether the borrower is likely to use the money they receive for something useful, such as a bona fide investment, or something frivolous, like a vacation or gambling. With greater assurances about the borrower, these data potentially allow the lender to lend more, lend for a longer period of time, or lend at a lower interest rate. Second, technology can be used to speed up transactions. Computers can do things in nanoseconds, whereas people take minutes. This means the same number of transactions can be done at lower cost, making the per transaction costs minimal. This means that more people can be served at the same cost. Next, technology allows for better matching. Computer programs can see the characteristics of borrowers from the information they put into the system and match them to the characteristics that lenders want. For instance, if a borrower wants to borrow for no more than 3 years and a certain lender also wants to be paid back in that same time frame, the computer can match these two people's loan maturity desires pretty much instantaneously. Moreover, computer programs can match data on multiple dimensions more easily than bank lending officers. Since the timing of these decisions can also be made faster, the entire intermediation process can be shortened and made more precise. Technology also lowers the barriers to entry by lowering fixed costs of operations. After the upfront cost of buying hardware, which is getting cheaper over time, and the cost of programming the components of a transaction are incurred, the ongoing costs of running the system are reduced substantially. Part of this is just a programming feature, but there are elements that suggest different financial networks or platforms, if they're programmed using common languages or features, can also talk to each other, thereby lowering costs through interoperability. For instance, some public payment systems also speak to traditional banks and allow payment instructions to flow through to a person's individual bank account. And finally, FinTech can enable greater economies of scope. This is another type of interoperability that operates across diverse types of information systems. Information from, say, a social media platform can be used to better understand a person's financial situation that may allow financial products to be targeted to that individual. In some cases, these social media firms may negotiate with other financial firms to team up to share information, or, what is becoming increasingly common, they integrate through mergers or acquisition to form a more seamless system.
Okay, so all that was discussed in that video, we are going to cover them over time. And like we'll see how it's happening in real time. Okay, so the mergers between bank and fintech company, that's a real thing that's happening in New Zealand. So we have seen BNZ and BlinkPay, so that's another fintech company. So like BNZ acquired BlinkPay, although they acquired BlinkPay, but the BlinkPay still works as a standalone business with having their own CEO. So like we can see that's already happening in like New Zealand, okay? And like this is only going to increase more over time. So that's all that I have to cover in this financial inefficiency bit, the weakness and opportunities for fintech. Make sure you go through the teaching materials and see if you have got any question. And next week you have got your presentation. Okay, the group presentation. Yes, you have got a question?
Hi, Abhishek. Regarding the presentation, do we need to prepare PowerPoint?
Yes, you will have to prepare a PowerPoint. Yes, that's right.
Right. Okay, so for the group presentation, does it mean like each person need to talk about like 15 minutes-ish?
Well, it's a total 10 minutes presentation. And how long each participant talks, I leave it on you. You know, like maybe, yeah,
10 minutes presentation?
Yeah, 10 minutes for the full presentation.
Okay.
How much each person talks, that depends on your group.
Okay, right. One more thing, I cannot type anything in the chat. Do you need to give me approval or something like that?
I don't know. I'll have to figure that out. Sorry about that. I'll figure that out in my next class.
Yeah, no worries. I just let you know. And Levi and Christy, if you don't mind, would you like maybe join group 1 so we can form a online group? That would be great. Thank you. Yeah, that's it. Thank you for your time today.
Yes, so all those who are online today, they can form a group together. That's great.
I'm going to be in class most of the time. It's just that today I couldn't find a park, so I had to rush home and join online.
Oh, I see. Okay. All right, I'll leave it to you to form a group. Okay, so all the online ones. See, so you've got the tutorials as well to form group, the Thursday tutorial. So if you're joining online, all the people who are joining online tutorials can like form a group, and the ones who are here in person, because I can see majority of you here in person. So yeah, good. Okay. Any other question? Concerns? I hope everybody have access to Moodle. Yeah. Thanks. All right, that's all from me today. Please attend the tutorial.
I want to be in my group and make sure we're in company public speaking.
Yes, you can now talk. You can use the time to form your group.
Thank you.
Thanks. Should be fine. Going to stop the recording now. Okay.